if there is one interaction and if there is one voice which everybody really looks forward to, at least on ET now, is Manish Chokhani. He's got years and years of experience, his ability to connect the market dots, his ability to really pick up the next big trend. And like he always, mentions that his ability to really identify where the puck will move rather when the puck has moved, I think is quite extraordinary. So, with great pleasure, let me now welcome Mr. Manish Chokhani on ET Now. Thank you for joining us. Is that you? Is that you, Manish bhai? Is that age, wisdom, experience on your face now?
It's age, too much travel.
Looking fresh after the travels.
Yes, yes. At least someone is smiling in this market, so good to see that you got a smiling Manish Chokhani.
I was thinking of wearing a green shirt, then I saw the screen and I went back to white.
The markets have taken a nasty knock. Everybody knew that this was coming. It is just that when it hit us, nobody was prepared for it.
Yeah, it's true. Uh, Even I never thought that we have a bubble in the market because the large caps actually hadn't really participated. And the bubble we used to always talk of was occurring in the small caps and the SME type IPOs. And that's where the pain has obviously been the maximum. And earnings have dramatically slowed down. So I think, you keep everything aside, keep what is happening in US, keep everything happening in China. If if our earnings had held up, we could have dealt with all of this. The reality of life is our earnings are not yet holding up. And therefore, one has to go through this period of readjustment.
Manish, I think the bigger question on everyone's mind is how much more pain, and especially for the Janta who's coming into the markets post-COVID, they've not really seen this kind of a gut-wrenching fall.
Yeah, well, I think everyone, including me, has been saying for a while that we have to get our earning expectations aligned. That if the return on equity of India Inc. by and large has been 15%, and that's typically been, the returns that the index has given over 20 years, 10 years, whatever, you can't be making 25, 30% compounded for 4 or 5 years and then not suffer some consequences of that. So I think that period of adjustment was very much required. I remember all of us from the markets were in this very famous now Jaipur Jamboree in December. And the mood was also quite unanimous over there that the markets have run far ahead of themselves. The best case would have been that if the markets had just gone sideways and allowed earnings to catch up with with valuations. However, markets have actually corrected downwards to start, giving people a chance to look at things that they may want to own for a longer term. And we say it very well that in bull markets, you rent stocks, and in bear markets, they return to their rightful owners. So bear markets actually for investors is probably a good thing, that stocks that you want to own for a longer duration of time, hopefully can now fall into your portfolio basket as well.
Manish, did you just call this a bear market? I know in technical parlance, we have entered into one for the small caps at least, but one was hoping that this was just a very, savage bull market correction at best.
Uh, no, the bull market uptrend, which is the structural long-term thing for 10, 15 years, I don't think I'm saying that is over. The country is still going to be growing in double digits in nominal terms. Earnings will still be growing in double digits in nominal terms. But if valuations, for example, on mid caps are still closer to 30 times than 20, and for the small caps are beyond 30 times, even today after this correction, you have to understand that these valuations are not sustainable, especially given the interest rates that are prevailing in the world and in India. And therefore, there is pain ahead. I would still think in the mid and small, there is still pain ahead. The large caps are now, at the long-term levels, which are, I think, 19 times forward earnings. But like when you go up, you exceed it on the upside. It also happens on the downside that things don't just end because they are realistic. They end when they become unrealistic and they become so mouth-watering that even someone like me who, for example, may not like to buy a lot of capital goods or commodities, even someone like me gets interested over there. But that is not yet there. I think we still have some room over there.
So, Manish, let's divide the market in two parts, and I'm just breaking it for our viewers. The reason why markets have sold off is because valuations were high and earnings have slowed down. Now, what exactly are markets pricing in? Where, to your mind, are the valuations, and where do you think earnings are headed?
Nikunj, I think we are still optimistic about earnings as a market. Because if I'm looking across my screen, other than say financials and maybe some metals and a few assorted here and there, the rest of the sectors are still pricing in as if in 3 months or 6 months, everything will get corrected and earnings will re-accelerate and go back to a 20% type growth trajectory. I don't think as yet that is realistic, especially given the uncertainty which is being caused in the rest of the world by the way Mr. Trump is, unleashing his tariff war across the world and creating uncertainty. Also in India, despite the stimulus that has been given to the middle class by way of budget cuts, 1 lakh crores is not some number which is going to suddenly unleash great consumer demand. It's always welcome, and it's a great move which was done. But the reality of life is that until we start some revival of a capex cycle and a job creation cycle, this earning acceleration is not going to come. And for that to happen, the corporate sector actually honestly has to pick up the slack this time. That the government has really done whatever it could in terms of giving you tax cuts, in terms of giving you rebates, in terms of giving you freebies as well to encourage. Also the PLI schemes and so on. It just comes down to you need a period of digestion after a party that we've had for 4 years. So sometimes it's just good that, like you say in the middle overs in a 50-over match, that sometimes just keep taking the singles and the twos and don't keep trying to hit boundaries. And wait for your time, because those bad balls are going to come your way, where prices for us to buy things will sometimes get mouth-watering. And we're just waiting for that.
So, Manish, I'm just again breaking it for our viewers, and perhaps we lean on your experience. There are two ways to create wealth: buy something which is small, potentially could become big, or buy something which has become cheap and is trading below its intrinsic value. So if you have to identify both these pockets, what is new and could become big, and what is good and is looking cheap?
So the second one is obviously easier, that the good which has become cheap, which we've spoken for some time, has been financials. And while last year we went and participated a lot over the last 2 or 3 years in capital market type financials, I think the time to come back to not only NBFCs but also some of the private sector banks which hadn't performed for some time. Like you would have seen, even in this kind of big sell-off, it's the erstwhile favorites HDFC, Kotak, and Bajaj Finance which have come back. Whereas in the 2-3 years prior, we had leaned very heavily into public sector banks, for example, because of just how cheap they were. So while that trade is realigning back to the better quality, better run financials, on the smaller ones which are going to become large, I think the market has got a bit overexcited with all the new themes which have come out. And I called out, I think, including in your show, even things like Zomato and all, which are absolutely great companies, that the market's paying too high a price too early for the potential which is there. And I remember I pointed out the example of Infosys peaking in 2001 at a $45 billion market cap. And it's only basically doubled over the last 20 odd years. So while the company and the business can do well, valuation is really what you have to be very cognizant of. And for whatever small thing, even I tend to buy things, and I'll give you a number which I always use in my head, that however great the business is or however great the potential is, can I foresee that this company is on a 5 multiple 5 years forward? Because that allows me to think about the business 5 years out. It allows me to see what I expect the multiple of that business to be 5 years out. If I get it wrong, assuming I bought a decent type business, I'll at least end up at a 15 type multiple, which means I'll triple in 5 years. And if I'm lucky, I'll get to a 25 multiple, which means I'll make 5 times in 5 years. And I don't think those sorts of opportunities as yet exist in our market. So I'm patient with the amount of cash which I was fortunate to create. And I'm sure I'll get a chance to deploy over the coming months.
If you like this video, then like, share and subscribe to ET Now.